Preparing for a financial analyst at Tengelmann interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to join Tengelmann as a financial analyst. I am a finance professional who enjoys turning operational data into clear decisions. My experience with budgeting, variance analysis, and Excel-based reporting has strengthened both my technical skills and commercial judgment. Tengelmann appeals to me because its diversified portfolio requires analysts to understand different business models rather than rely on one standard template. I would bring accuracy, curiosity, and ownership, while learning how management evaluates performance, allocates capital, and supports long-term value creation across its companies. While answering, focus on your analytical foundation, interest in diversified businesses, understanding of Tengelmann's entrepreneurial investment culture, relevant tools, and how your experience supports disciplined decision-making across operating companies. Question 2. What do you know about Tengelmann and its business model? Tengelmann is a family-owned German investment and holding group with a long history and interests across multiple sectors, including retail, digital businesses, and real estate-related activities. Its model combines ownership, investment, and active support of portfolio companies. That means financial analysis must go beyond reporting historical earnings. It should explain operating drivers, cash generation, risks, and capital needs. I would approach each business according to its economics while maintaining consistent group-level reporting and controls. Make sure to cover Tengelmann's family-owned heritage, diversified investment activities, operating company exposure, long-term orientation, and the importance of evaluating both financial results and strategic development. Question 3. Walk me through the 3 financial statements and how they connect. The income statement shows profitability over a period, the balance sheet shows assets, liabilities, and equity at a point in time, and the cash flow statement explains changes in cash. Net income flows into retained earnings and begins the operating cash flow calculation. Balance sheet movements, such as receivables, inventory, and payables, adjust accounting profit to cash. Investing and financing activities complete the cash flow statement. I always reconcile ending cash to the balance sheet and investigate inconsistencies. In your answer, talk about the income statement, balance sheet, and cash flow statement, net income linkage, working capital movements, non-cash items, and the importance of checking that the balance sheet balances. Question 4. How would you analyze a subsidiary whose revenue is growing but profitability is declining? I would first separate growth into price, volume, and mix, then bridge gross profit from the prior period. A decline could reflect discounting, lower margin products, input cost inflation, or customer concentration. Next, I would examine personnel, logistics, marketing, and overhead costs for fixed cost deleverage or unusual items. I would compare actuals with budget and prior year, validate the data with management, and finish with actions such as repricing, assortment changes, or cost controls. Be sure to mention price-volume mix analysis, gross margin pressure, customer and channel mix, operating leverage, cost inflation, one-off items, and comparison against budget, prior year, and relevant peers. Question 5. What is the difference between EBITDA, EBIT, and operating cash flow? EBITDA measures earnings before interest, taxes, depreciation, and amortization, while EBIT includes depreciation and amortization. Operating cash flow starts with accounting profit and adjusts for non-cash charges and working capital movements. Therefore, EBITDA can be a useful operating comparison but is not cash available to the business because it ignores taxes, working capital, and capital expenditure. For liquidity analysis, I would emphasize cash flow. For operational benchmarking, I would use EBITDA alongside margins and reinvestment needs. Focus on the definitions, depreciation and amortization, working capital effects, capital expenditure differences, why EBITDA is not cash flow, and which metric is most useful for the specific analytical question. Question 6. How would you build an annual budget for a Tengelmann portfolio company? I would begin with the business model and identify drivers such as volumes, prices, customers, store productivity, headcount, and supplier costs. I would use historical performance as a reference, but challenge assumptions rather than simply extrapolate them. Then I would build revenue, gross margin, operating expenses, working capital, capital expenditure, and cash flow. I would include base, upside, and downside cases, document assumptions, and review the budget with operating management before finalizing targets and monitoring metrics. While answering, focus on the operating driver approach, historical trends, management assumptions, revenue and cost buildup, headcount, capital expenditure, working capital, scenario analysis, and alignment with strategic priorities. Question 7. How do you perform a meaningful variance analysis? I start by identifying material variances against budget, forecast, and prior year, then classify them by revenue, margin, operating costs, and cash impact. For sales, I separate price, volume, and mix. For costs, I distinguish rate, usage, timing, and one-off effects. I validate explanations with the responsible managers and assess whether the issue is temporary or structural. The final report should state the cause, financial impact, outlook, and proposed action, not just display percentages. In your answer, talk about materiality, favorable versus unfavorable variances, price-volume mix bridges, timing and one-offs, root cause investigation, management discussion, and corrective actions rather than merely reporting differences. Question 8. Which KPIs would you monitor for a retail or consumer-facing business? I would monitor like-for-like sales, customer traffic, conversion, average basket size, gross margin, markdown rates, inventory turnover, stock availability, labor cost per sales unit, and cash conversion. I would also segment performance by store, channel, product category, and geography. The key is linking indicators. Strong sales growth is less attractive if achieved through heavy discounting or excess inventory. I would track both leading operational measures and lagging financial outcomes to identify problems early. Make sure to cover like-for-like sales, traffic, conversion, average basket, gross margin, inventory turnover, markdowns, labor productivity, working capital, and the connection between operational metrics and cash generation. Question 9. How would you assess whether an investment or acquisition creates value? I would evaluate strategic fit first, then build a normalized earnings and free cash flow forecast. The analysis would compare purchase price with EBITDA, enterprise value, expected synergies, capital requirements, and the resulting return metrics, including IRR and money-on-money return. I would test downside scenarios for slower growth, margin pressure, delayed synergies, and higher investment needs. A compelling case requires returns above the hurdle rate and a realistic path to execution, not merely an attractive headline multiple. Be sure to mention strategic fit, normalized EBITDA, purchase price, synergies, free cash flow, valuation multiples, return thresholds, downside cases, integration risk, and sensitivity to key assumptions. Question 10. Explain how working capital affects cash flow. Working capital determines how much operating profit becomes cash. An increase in receivables or inventory uses cash, while an increase in payables provides cash, assuming the changes are operationally sustainable. For example, a company can report higher sales and EBITDA but still face liquidity pressure if customers pay slowly and inventory builds. I would analyze days sales outstanding, inventory days, and payable days, adjust for seasonality, and identify actions such as better collections or inventory planning. Focus on receivables, inventory, payables, operating cash conversion, increases versus decreases, seasonality, supplier terms, and the risk that reported earnings may not translate into liquidity. Question 11. What is a DCF valuation, and which assumptions matter most? A DCF values a business by discounting forecast unlevered free cash flow and terminal value to today using the weighted average cost of capital. The most sensitive assumptions are usually long-term growth, operating margins, working capital, capital expenditure, and WACC. I would build a transparent operating forecast, calculate terminal value using a perpetuity growth or exit multiple approach, and run sensitivities. Finally, I would bridge enterprise value to equity value by adjusting for debt, cash, and other claims. While answering, focus on unlevered free cash flow, forecast period, WACC, terminal value, revenue and margin assumptions, reinvestment, sensitivity analysis, and the difference between enterprise and equity value. Question 12. How would you evaluate a company with negative EBITDA? Negative EBITDA is not automatically unacceptable. The reason and path to profitability matter. I would examine unit economics, gross margin, customer retention, contribution margin, fixed cost structure, cash burn, and available funding. For a growth business, revenue multiples or cohort metrics may be more relevant than EBITDA, while a mature loss-making company may require a turnaround analysis. I would test whether scale can improve margins, quantify the break-even point, and distinguish investment-led losses from fundamentally weak economics. In your answer, talk about the reason for losses, unit economics, cash burn, runway, customer acquisition, scalability, comparable metrics, turnaround potential, and avoiding unsuitable valuation multiples. Question 13. What is the difference between international financial reporting standards and German generally accepted accounting principles, and why does it matter to an analyst? International financial reporting standards is generally designed to provide decision-useful information to investors, while German HGB places greater emphasis on prudence, creditor protection, and cautious profit recognition. Differences can affect asset valuation, provisions, leases, development costs, and deferred taxes. As an analyst, I would first confirm the reporting framework and accounting policies, then avoid comparing metrics without adjusting for material differences. I would also understand whether group reporting uses consolidation adjustments that make subsidiary statutory accounts non-comparable with management reporting. Be sure to mention International Financial Reporting Standards' investor-oriented presentation, HGB's prudence principle, recognition and measurement differences, comparability, consolidation, deferred taxes, and the need to understand the reporting basis before analyzing trends. Question 14. How would you improve the accuracy of a monthly management reporting pack? I would begin by documenting KPI definitions, data owners, reporting deadlines, and the bridge from source systems to the final pack. I would automate repetitive imports where practical, add checks for missing data, unusual movements, and balance sheet reconciliation, and maintain clear version control. The pack should distinguish actuals, budget, forecast, and prior year consistently. Finally, I would require concise commentary explaining material variances and actions, so management receives insight rather than a collection of unconnected tables. Focus on standardized definitions, source data controls, reconciliations, deadlines, automated checks, variance commentary, ownership, version control, and balancing concise presentation with actionable insight. Question 15. Describe a time you found an error in financial data. What did you do? During a monthly reporting process, I noticed that a cost ratio moved sharply despite stable operational activity. I traced the variance to a duplicated supplier file in the consolidation upload and quantified the impact before changing anything. I informed my manager, corrected the report, and documented the issue transparently. Afterwards, I added a duplicate check and reconciled the upload total to the general ledger. The experience reinforced that speed matters, but controlled verification matters more. Make sure to cover how you detected the issue, quantified its impact, verified the root cause, communicated professionally, corrected the output, and introduced a control to prevent recurrence. Question 16. How would you forecast cash flow for a group with several subsidiaries? I would collect standardized weekly or monthly forecasts from each subsidiary, covering customer receipts, supplier payments, payroll, taxes, capital expenditure, debt service, and intercompany movements. I would reconcile opening cash to bank data and challenge assumptions using historical conversion and payment patterns. At group level, I would eliminate intercompany flows, identify funding gaps, and maintain downside scenarios for delayed receipts or weaker sales. The output should highlight available liquidity, minimum cash levels, and decisions required from management. In your answer, talk about subsidiary-level forecasts, receipts and payments, working capital timing, tax, payroll, capital expenditure, financing, intercompany flows, liquidity buffers, and scenario updates. Question 17. What Excel techniques are most valuable for a financial analyst? I rely on structured workbooks with separate input, calculation, and output sections. Useful tools include SumIfs, XLOOKUP, index match, pivot tables, conditional checks, scenario switches, and sensitivity tables. For recurring reporting, Power Query can reduce manual data preparation. I avoid hardcoding wherever possible, label assumptions clearly, and build checks for balance sheet balancing, cash roll forward, and unexpected blanks. A strong model is not just technically sophisticated, another person should be able to review and update it confidently. While answering, focus on clean model structure, SumIfs, index match or XLOOKUP, pivot tables, logical checks, data validation, sensitivity tables, charts, Power Query, and avoiding fragile hard-coded assumptions. Question 18. How would you explain a complex financial result to a non-finance manager? I would lead with the conclusion and business impact rather than accounting terminology. For example, I might say, profit is below plan mainly because freight costs increased and inventory moved more slowly. Then quantify each driver and explain the cash implication. I would use a simple bridge or chart, define any unavoidable technical term, and connect the finding to an action. Before finishing, I would confirm the manager's understanding and invite operational context that could improve the analysis. Be sure to mention starting with the business question, using plain language, focusing on drivers and implications, limiting technical detail, quantifying impact, confirming understanding, and recommending a practical next step. Question 19. How do you prioritize when several senior stakeholders request analysis at the same time? I would clarify the decision each request supports, its deadline, financial importance, and dependencies. A liquidity issue or board deadline would normally take precedence over a lower-impact exploratory analysis. I would estimate effort, agree sequencing with my manager, and communicate realistic delivery times to stakeholders. Where possible, I would provide an initial directional answer before a fully detailed version. If priorities genuinely conflict, I would escalate early with options rather than allowing both deliverables to become late. Focus on urgency, decision impact, deadlines, dependencies, effort, transparent communication, realistic sequencing, and escalating conflicts early instead of silently missing expectations. Question 20. What questions would you ask before presenting a recommendation to Tengelmann management? Before presenting, I would ask what decision management needs to make, which objective matters most, and whether the analysis uses the latest reliable data. I would challenge key assumptions, quantify sensitivities, and test downside risks, particularly around cash, execution, and timing. I would confirm strategic fit and identify who owns implementation. Finally, I would make the recommendation explicit, explain alternatives, and state the approval or next step required so the discussion leads to action. In your answer, talk about decision objectives, data quality, assumptions, sensitivities, strategic fit, implementation ownership, downside risks, timing, and the specific decision or approval required. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.